100,000 euros. If you've ever looked into what happens to your money when a bank fails, you've seen that number. European law guarantees it. It's one of the most reassuring facts in personal finance, and it's also one of the most misunderstood. Because most people assume that same number, the same government backstop, protects everything else in their portfolio too. Their ETFs, their shares, their brokerage account. It doesn't. Not because the rules are weaker there, but because it's a completely different kind of rule built on a completely different idea of what your money actually means once it stops being cash in a bank account. And once you understand the difference, you know something about your own portfolio that almost nobody checks. Now, quick note, this is not financial or legal advice. Protection rules vary by country and by institutions, so treat this as a framework and verify the specific figures for your own bank and broker. Today, we'll go through three things in order. First, how deposit protection actually works and why the 100,000 euros figure exists in the first place. Second, why the securities in your brokerage account, your ETFs, and your shares sit under a completely different legal principle. Not a smaller protection, a different kind of protection. And third, and this is the part almost nobody checks, there's a second, much smaller safety net sitting underneath that protection. And its size depends on something most investors never think to look up. By the end, you know exactly which category every euro of your portfolio actually falls into. Here's the mechanic almost nobody thinks about. When you deposit cash into a bank account, legally, that cash stops being yours in the direct sense. It becomes the bank's asset. You become a creditor, someone the bank owes money to, on demand. That's why deposit insurance exists at all. Your cash is now sitting on the bank's balance sheet. And if the bank fails, you're in line with everyone else the bank owes money to. EU law fixes what happens next. Under the Deposit Guarantee Schemes Directive, every EU country has to guarantee deposits up to 100,000 euros per depositor, per bank, if the bank can't pay out. That's not a suggestion. It's a harmonized minimum, and every licensed bank in the EU has to be part of the National Deposit Guarantee Scheme, funded by the banks themselves. A few details worth knowing precisely, because they trip people up constantly. The 100,000 euros limit is per bank, not per account. If you've got a current account and 3 savings accounts at the same bank, they're added together. 100,000 euros ceiling covers all of them combined. For a joint account, that limit applies to each person on the account, separately. 2 people, 1 joint account, 200,000 euros in effective coverage. This is written directly into the directive. Each depositor's share is calculated on its own and split equally between the account holders unless a different arrangement is on record. And if a bank fails, the payout window is fast. 7 working days as of the current rules. So that's the deposit side. Clean, simple, and backed by an actual government-mandated scheme. Now, here's where it gets interesting. Because the moment you buy an ETF instead of holding cash, none of this mechanism applies anymore. Not because you're less protected, but because you're not a creditor anymore. When you buy an ETF or a share through a broker, something completely different happens legally. You're not lending the broker money and hoping to get it back. You own the security directly the whole time. So what's the security exactly? Not a paper certificate sitting in a vault somewhere. That image is decades out of date. Under EU rules, virtually every listed security today is dematerialized. It exists purely as an electronic book entry, a verified record of ownership, not a physical object. That record sits with a central securities depository, an institution like Euroclear or Clearstream, or a national depository, which acts as the master registry for that security. Your broker holds an account at that depository, directly or through a sub-custodian, and it's the broker's own books that record you specifically as the person behind that entry. There's no safe, no paper, just a verified electronic chain of who owns what. The broker's job is custody, holding that record on your behalf, executing your trades, handling dividends. Under EU law, specifically MiFID II, brokers are required to keep client securities legally separate from the firm's own assets, segregated, ring-fenced. That's why there is no 100,000 euros style cap on your ETF holdings. It's not that the protection is smaller, it's that the entire logic is different. Deposit insurance protects you because your cash became the bank's liability. Segregation protects you because your securities never became the broker's asset in the first place. If the broker collapses tomorrow, your ETF shouldn't be part of what its creditors can claim. It was never theirs to lose. Now, and this is important, so I want you to be precise about it. That doesn't mean your investments are unlimited protected. Segregation protects you against one specific failure: the broker going bankrupt and creditors trying to claim your assets. It does not ever, anywhere in the EU, protect you against your ETF simply losing value. Nobody insures market risk. That's not a gap in the system. That's the system working as intended. You're supposed to carry investment risk. You're not supposed to carry custody risk. So where does custody risk actually get covered? That's point 3, and this is the part that almost nobody in Europe has ever actually looked up. Segregation is supposed to mean your securities are safe even if your broker fails. Supposed to. But segregation can go wrong. Fraud, administrative failure, a broker that simply can't produce the securities it was supposed to be holding for you. For exactly that scenario, the EU has a second separate, much smaller safety net: investor compensation schemes. EU law sets a minimum here of just 20,000 euros, not 100,000 euros, 20,000 euros. And unlike deposit insurance, this scheme has one hard rule. It never, under any circumstance, compensates you for an investment losing value. It only pays out for fraud or operational failure. The broker literally being unable to return what it was holding for you. Here's where it actually gets useful to know your own situation, because this cap is not the same across the EU. Countries set their own level above that 20,000 euros floor, and the differences are large. Germany, the Netherlands, Italy, and Belgium all sit at the EU minimum, 20,000 euros. France sits considerably higher, at 70,000 euros. Spain is the highest of the group, at 100,000 euros, the same figure as deposit protection, just under a completely different scheme. And here's the detail that actually matters for you. This cap is set by where your broker is legally authorized, not by where you live. Two people in the same country using two different brokers licensed in two different EU states can have completely different compensation ceilings on the exact same portfolio. This isn't hypothetical. When Interactive Brokers consolidated its EU operations from its Hungarian entity into its Irish entity in August 2024, Clients under the old entity saw their compensation cap change overnight, from 100,000 euros down to 20,000 euros, purely because the governance scheme changed underneath them. Nothing about their actual holdings changed. The legal jurisdiction did. That's not a reason to panic about any specific broker. Segregation still protects the actual assets regardless of which compensation scheme applies, but it's a reason to actually know which scheme covers you, instead of assuming a number you've never checked. 4 things to do on a personal level concretely. 1. Find out which country your bank and your broker are actually authorized in, not where the website is translated into your language, but the legal entity behind the account. That single fact determines which scheme covers you. 2. If you're holding more than 100,000 euros in cash at a single bank, know that spreading it across separate banking groups keeps each portion under the deposit guarantee. 3. Understand permanently that no scheme anywhere in the EU compensates you for an ETF or a stock losing value. That risk is yours, by design, in every single case. 4. Your broker has a client asset protection or investor compensation disclosure page. It's usually one search away, and almost nobody has ever read it. Go read yours this week. And if you want a broader gut check on your ETF holdings beyond just how they're protected, the free European ETF investor checklist linked below covers the 7 things worth verifying before you put money into any fund. So the 100,000 euros figure you already knew isn't wrong. It's just answering a different question than most people think it's answering. Your cash at the bank and your ETF at the broker are protected by 2 entirely different ideas of what yours means. And only one of those ideas comes with a number most people have actually bothered to check. Remember, money is a tool. If you don't learn to control your finances will control you.